Hi, everybody. It's November 20th, the market update desk with Scott Riley, NMLS number 157524. Well, we've got relative calmness in both the stock market and bond market so far today. Now, there's a very critical item coming out after hours today, and that's going to be NVIDIA earnings. That is the 900-pound gorilla in the AI world, and they've been well, I should say, one of the core drivers of the stock market, going so high in the last 24 months. Now, what we've started to see in NVIDIA earnings, starting last quarter, is not that they're not growing. They definitely are. They're definitely very profitable, but the rate of growth, the rate of profitability is starting to balance out. So we're not seeing the percentage gains as what they used to have. So it's going to be very interesting to see how the stock market and really the bond market interprets this. For example, if we have blowout earnings in future projections from NVIDIA and other companies, you could start to see another movement from the bond market to equities, the stock market. So, which would be a negative possibility for mortgage rates. So we're going to watch that really, really close. Something during Chairman Powell's speech the other day is that he said the Fed is seeing strength in the economy and they are not getting signals that they need to be in a hurry to drop rates. But consumers are currently not feeling that way. So we've got a dichotomy going on with what Fed sees in numbers and stock market and what consumers feel on a day-to-day situation in their pocketbook. Going into that deeper, the New York Fed survey of consumer finances showed that for the second month in a row, the mean probability of the household sector being able to stay current on their debt obligations was around 14%. Now, this has not happened since March and April 2020. Almost 40% of those surveyed claim that their financial situation today is not as good as what it was a year ago, despite what we're seeing in the stock market of huge gains and the ongoing home appreciation. Now, those are two different things. So we see these asset classes growing, but the affordability on a day-to-day peaking, not making gains. So we've got these two different things that are happening in the market to two large segments of the population. So we also, to kind of lay credence to that, Lowe's in their earnings call this week indicated that they're struggling to move big ticket items, and Walmart's earnings reported at 75% of its market share came from households making over 100,000. What does that mean? We've talked about consumers taking a step down in quality, in price point, and in where they're shopping. This definitely is a wake-up call for a lot of people. The economy, in a lot of aspects, is very good and very solid and growing, but for a lot of aspects, it is not, which, that focuses on the affordability aspect. Going into that, with houses and what we talked about yesterday with inventory continuing to struggle probably for the foreseeable future. That's why it's more important to find something now rather than later, regardless of rate, because the price is going to be more later because of the lack of inventory. We're going to keep watch of it. We're still trading in that very wide range in the bond market and mortgage-backed securities. We'll see if we break out of that. 616-293-2189. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan. Have a great day, everybody.